This quote from Warren Buffett, it's really about the immense power of saying no. It forces us to think about how we use our most valuable, most limited resource, our attention. So let me just ask you this. What if the smallest things in your portfolio are actually the most expensive? It sounds completely backward, doesn't it? But there's a hidden cost that might be quietly undermining your most important investment decisions. And that hidden cost is exactly what we're here to talk about. It's called the attention cost. In this explainer, we're going to dive into why your smallest, most insignificant seeming investments might just be the most expensive assets you own.
You see, this whole principle is universal. Our attention is a finite resource. A trial lawyer, a surgeon, a chess grandmaster, they all understand this. Success in any high-stakes field comes down to how you allocate that limited mental energy. And investing, as we're about to see, is absolutely no different.
Okay, so let's make this abstract idea tangible. Let's make this invisible cost visible. This brings us to our first section, the arithmetic of attention. Let's start with a really familiar scenario. Imagine you have a $1 million portfolio, and inside it, you've got this tiny $2,000 speculative biotech stock. Some news breaks, and you decide to spend just 30 minutes digging in, reading reports, checking commentary, trying to figure out what to do. But what did that half hour really cost you? Well, if we say your time is worth about $300 an hour, that quick dive just cost you $150. And just like that, the invisible cost starts to have a very visible price tag. And this is where the math starts to get really startling. That $150 represents 7.5% of the entire $2,000 investment. You've essentially paid a 7.5% fee just for thinking about the stock for 30 minutes. And of course, we both know it's never a one-time thing. A speculative position like this demands constant attention. It nags at you. Conservatively, you might spend 4, maybe 6 hours over the course of a year just reading updates, checking prices, and generally worrying about it. Now, this is where the flawed logic just becomes undeniable. Your annual attention cost at $300 an hour is somewhere between $1,200 and $1,800. What's the best case optimistic annual gain on that $2,000 position? Maybe 7%, so $140. The imbalance is staggering. You're paying 8 to 12 times more just to monitor the position than you could ever realistically expect to gain from it. But believe it or not, that direct cost isn't even the full story. The real price you pay is much, much higher. And that brings us to our second section, the displacement value. So what is displacement value? It's the value of the high-impact, portfolio-defining decisions that you didn't make, simply because your attention was consumed by the small stuff. Think about what you could have been doing with that time. Instead of getting bogged down by that tiny stock, you could have been evaluating a $50,000 index allocation, or analyzing a $30,000 opportunity to average up on a true winner, or reassessing a $60,000 core holding that's starting to show weakness. These are decisions whose impacts are measured in thousands or tens of thousands of dollars. The opportunity cost is enormous. And this really gets to the heart of the matter. The cost of a small position isn't measured by how much money you might lose on it. It's measured by the quality of the big decisions it displaces. All right, so we get the problem. The critical question now is, what do we do about it? That brings us to our third section, portfolio implications. We're moving from theory to action. This thinking leads us to a clear, powerful rule. We can call it the minimum position size. And the definition is this. It's the size below which the attention cost of monitoring the position exceeds its expected financial contribution. If a position doesn't clear that hurdle, you simply shouldn't own it. The arithmetic is that clear.
This framework gives us 4 very practical rules. 1, create a size floor. Buy enough to actually matter, or don't buy it at all. 2, apply the attention test. Does this position truly justify the mental energy it will consume? 3, concentrate to preserve your attention. Fewer positions lead to better focus and better decisions. And 4, reframe how you see cash. Cash isn't lazy, it's strategic, because it has an attention cost of 0.
Okay, now for our final section. And frankly, the most profound idea of all. Let's talk about the cognitive 100 bagger. This is where we see how protecting your attention becomes its own powerful compounding force. We've all heard of a capital 100 bagger, right? The dream investment that multiplies your money 100 times. But there's another, more powerful type of compounding, the cognitive 100 bagger.
This isn't about the compounding of money in your portfolio. This is about the compounding of decision quality in you, the investor.
Just as a tiny fraction of stocks drive almost all market returns, a tiny fraction of your decisions will generate nearly all of your lifetime returns. Everything else is just noise. And the only thing noise does is dilute your attention away from what truly matters.
And that's the real secret of the world's best investors. It's not that they have more mental bandwidth than the rest of us. They are just absolutely ruthless about not wasting the attention they do have.
So, it all comes down to this single, powerful maxim. Capital compounds in the portfolio, attention compounds in the investor, and you have to protect both with equal vigilance. To explore these investment strategies further and discover more from the collection, visit the website averagingup.com.